Now, let's take a minute and take a look at these bars here, because, this is a 15-minute chart. What are you going to do when you're long and the market moves up and you have a nice lead, but the next bar moves back down to relatively closely to where you got in? What do you do with that? Are you placing your stop right here because as soon as they're ahead of you, you don't want them to touch your price? What exactly are you going to do to manage your position? I'm sort of asking rhetorically, how do you manage that? How would you manage that position? Can you allow the market to come through your price once it's ahead of you? Should you allow the market to come through your price? Now, it actually didn't come through your price here, assuming that you got in, let's just say you got in at 43.05. When they pulled back to 43. They happened to pull back to 43.07. But I wonder how you would manage that portion of the trade, because trade management is, it's the whole thing. Once you have a good idea of what the market's going to do, trade management becomes the whole bloody thing from that point forward. And I think it's fair to say that you have to be, and we both have to be, just as good at trade management as we are at knowing what the market's likely going to do. Those are two distinctly different skills. And the trade management skill, honestly, is way more emotional. It doesn't need to be, but generally it is, because real money is at risk and so on. So there is something to be learned, about every part of trading in markets and how you are going to act under certain conditions. And I think it's a really good idea to think through how you're going to respond if the market does certain things while you're in a so far successful position. Now, I used to never use a stop many, many long years ago. This terrible to even talk like that, but there are many people who do that to this day. And my premise was the market's eventually going to come back. What I didn't know back then is that before they eventually come back, they can go a whole lot further than you're thinking they will against your position. And at some point, it becomes silly to still be in a position. You're now losing opportunities that would be there because you can't, let's say you were long, you can't really take any short positions because that would, end your long position that you're coveting and holding on to, hoping the market's going to come back. Wouldn't you agree that one of the worst feelings is that, you're in a position and the market is against you and you're hoping it comes back? That's a really terrible feeling. So can we set up a trade? Can we put a forecast together that sort of assures us that there's more than one facet that is positive for the market to move in a specific direction? This is what I try to do. So I'm never going to trade like the idiots that I see on the internet. And really, idiot is the word. That they're looking at a 5-minute chart and their blue line crosses the green line, and therefore that means go long. But it's with no reference to anything else. Without that reference to something else that would be positive for that trade, something outside and beyond their 5-minute chart. Without that, when the market moves against them, they have no such certainty that it's going to come back, or they're going to be stopped out numerous times because the market really is got some other force working on it. So to the downside. So it is important to us that when we have a forecast, that we're trading that forecast in such a way that there's always, in most cases, something larger that assures us that that move is going to continue higher. Even if there is a short-term pullback on the way up, we're much more tolerant of that. And the reason I'm saying this is because many times I don't initially have a stop physically in the market, and I'm not saying, oh, I have a mental stop. No, I actually won't have a stop for some period of time in the market as the trade is developing. because if I have two levels saying that the market's going to go up, the shorter term level that got me in and the longer term level that is the real reason that I was going to a shorter term level to get in, those two things are in my favor, I can tolerate some pullback because the likelihood is that the market is going to recover, just like this morning. We were long in here. The market moved against our position down to here. And the likelihood was that it was going to recover because there's a much larger piece that's pushing the market higher. So I do think it's very important. I'm not suggesting that you operate without a stop, but I just want you to know that there is a reason for how I particularly put trades on. One of those reasons is that I have more than one level telling me that this move is going to happen. And sometimes I might even have three levels, three separate indications that say this thing is going to happen. And because of that, I'm more tolerant to minor pullbacks in the initial part of the trade. Then when the market confirms and starts moving higher, then I'm starting to place stops because the market went through its little show, it got it out of its system, and now it's starting to show that the move is really on. Or take this chart in the center here. We were long in here, the market pulled back, but once it got underway, now stops are being placed, at least in my particular case, that would protect the remainder of the position. I would never use that premise of having no stop initially unless I had already done the homework to know that the market is very likely to move higher, not just because the green line crossed the blue line on a 5-minute chart, but because several other things of vastly greater importance are pointing to higher prices. That's how I tolerate that. I'm not just saying, oh, I'm just going to spin the wheel. I have figured out that the market's very likely to go higher. And therefore, the initial part of the trade, if they want to go sideways or dig in a little bit, I'm much more tolerant of that, and then start placing stops when the market starts to confirm. Those larger time frames are confirming that the market is moving up. Then I start placing a protective stop. And for those of you that are new, I never try to get out at a break even. That is a completely human level, non-thoughtful level. That's just a thing that people do because they don't want the market to move against their position. But that's especially true at the start here when the market moves against a position initially, which happens in some of our forecasts, and then the market gets underway. But the premise of rushing a stop up to a break even is not a really good idea. Now, later in the trade, when the market's really moved to somewhere and your stop is moving up, you're moving your stop up and so on, at some point you're way, way beyond a break even, but your stop is going to be pretty close to the current price action, let's just say. Nothing wrong with that. I'm just saying that the premise that so many people, because it is a human level thing, you don't want to see it come back against you. Honestly, in the majority of cases, that's the wrong thing to do for the trade. So if this over here happens and the market goes up and suddenly you've gone from 43.04 to 43.21, you sure as hell don't want to be stopped out below 43.04, right? That's the last thing you want to see happen. So you're going to move your stop up to a point where you can get out at a break even. That's usually the worst thing to do because the market will probably stop you out at a break even and then move on to give you this beautiful move up. So there is a time and a place for a stop. When somebody says, do you use stops? That's not really the right question. The right question is, where and when do you place a stop in the market? Not just do you use stops, but where and when do you place a stop? And that where and when it can be, and in my case, in our case, is very often determined by the amount of homework we did on the trade to know that certain things are very likely going to occur. That will help us to determine the where and the when of even having a stop in the market. So we're not saying, oh no, hey man, we just use mental stops. No, But we do use them, and if we're going to use them, they're going to be in the market. It's just, when do we place them? And the answer to that is when the market starts to confirm the actual move that we had forecast. Otherwise, at some point, we're going to have to say, we're just bloody wrong. The thing just keeps going down, and we have to step aside. And that can and sometimes does happen.